In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, good afternoon once again, Market Rebels. And Stu, you have, looks like a little analyst wingman sitting with you. Who have you got with you?
He is not only an analyst, he is the analyst.
He's the analyst.
This is Chance. This is my little buddy Chance, and Chance. we are coming to you from South Florida, your neck of the woods, man. We took a 26-hour car ride, and here we are. We have a little family gathering that we had to attend, so we all hopped in the car, and here we are.
Well, very cool. What kind of dog is he?
He is a mini Labradoodle. Say hi, buddy. Hi.
Hey, buddy.
Say hi to everybody.
He's a very cool dog, and I think you have a second one, don't you? Have a duplicate,
he's
a Xerox copy.
He's a little shy. That's Dallas. We have Chance and Dallas. Yeah, he's hiding. Hi, buddy. Yeah, he's hiding now. So.
All right.
Well,
anyway, very cool dog. Thanks for joining us there, Chance. And
right, ahead,
today what we want to bring to you is something that we actually talked about briefly in one of our recent Q&A sessions, but it's also to give you a little taste of what Stu and I are going to be doing in Miami in late January. And it really fits the theme that we've always tried to do, not just with us, but really I think everybody at Market Rebellion, is we don't want to show you what everybody else shows. We're not here to say, here's what a covered call is. Here's what a vertical spread is. You can find that stuff for free anywhere. It's not going to help.
And it's usually going to be wrong.
And it's usually going to be wrong, correct. So what we like to do is to show you, I like to call it more behind the scenes, behind the curtain look at what professionals look at and how we look at quotes and limit order boards and strategies and why we might enter here or exit there. It's a lot more of the finer details. Unfortunately, a lot of times new traders go, this is so technical. Who needs it? Just tell me what to buy. Oh, I think it's going up, buy a call. That's all you need to know. Nope, you have to know a lot more than that. And if you really want to succeed, you have to understand what the professionals understand and the way that they're playing. So one thing we thought was kind of cool, again, we kind of touched on this in Q&A, and it's one of the interesting, what we might call crossover points in options pricing. So let's go dive in and find out what this is all about. And as always, let's start off with Chalk Talk, our little thought-provoking question for everyone out there. So kind of a generic question, I get that, but what's significant about Delta 65?
It's so funny because through the years, I find myself gravitating to the 65 Delta option. Yeah. Both for myself and for my coaching students through the years, even way back in the early 2000s when I started doing the teaching. That was like the go-to option, that 65-ish Delta.
Yeah. Now, I know you know the details behind this, but even if you didn't, somebody who's been trading at your level for that long, at a professional level, you were a market maker for what, 29 years on the PhilX.
Yeah.
Even if you didn't understand the math behind it, and again, I know you do, but I'm saying even if you didn't, you would learn. You would say it seems to be something right about this 65 delta that I
Yeah.
notice that this happens and that happens, and most
Yeah.
traders are completely oblivious to it.
Most are. It's that. Well, you'll find out here. It's that kind of like meeting of the minds
It's
place.
exactly, yep,
Yeah.
yep, kind of a transition point. So it's something that
Yeah.
if you're going to succeed with options, you've got to know the details. Stop trying to find the red light, green light system where you're just going to say, tell me what to buy. Or again, stock is going up, you buy call, that's all you need to know. That's
You
going to
know,
get you hurt.
a great example, a little side note here, great example. Bill, you and I were in Q&A the other day. We were talking about that calendar spread,
Right.
and we had that upside tilt. Sometimes I call it a wrong side tilt that was going on. Nobody's talking about that stuff. Let's just talk about
That's
the
the primary
calendar.
reason for doing a calendar spread.
Where do you make the money, and what happens to the tails and all that kind of stuff. But who's talking about the vol tilts? We are.
Right.
That's who's talking about it.
Right. Everybody else says you do a calendar spread because you think it's going to sit still. Dead wrong. That's going to get you hurt bad. So let's take a look at the presentation and you will clearly find out what the answer is. We'll come back and revisit it for sure, but it's be very clear. So before we get started, please remember right there, Stu, marketrebellion.com/get started. We have lots of articles and videos on topics just like this, absolutely free. I don't even think you need to sign in with an email. It's all just sitting right there at the web. But we got lots of cool stuff to help you get started. So check that out. So let's start off, first of all, with a look at our friend, the bell curve. Now, why do we look at this? Well, a number of reasons is that options pricing comes from this. Now, I should probably hit the brakes here a little bit. Sometimes people say, oh, wait a minute, Black-Scholes model, completely wrong, dead wrong, completely got it backwards. Well, why did it win a Nobel Prize? And the reason that people think they got it backwards is they say, I know that stock prices follow a log normal curve. And therefore, because Black and Scholes assumed a bell curve, it's dead wrong. Well, that idea is dead wrong because the details are Black and Scholes, they do what's called a transformation. They take the logs of these price changes and bang, you've got yourself a normal curve. So this is the way when we start modeling stock price changes that we typically look at a bell curve. If we have a low volatility environment, we get a very tall, skinny curve. If we have a higher vol environment, what happens? Curve gets shorter and wider. It's just telling us that we have more things that can happen out here in the tails, right out here.
And more things will happen. How about that?
More things will happen.
And more things will happen. And that x-axis down there, guys, that's your range. That's what
exactly
we're
right.
talking about.
Yes, just showing the
range
range of stock prices. So now, for any given bell curve, we have certain standard deviations down here. But the point that I want you to understand now is that think of a stock, maybe this is at 100. Maybe this is our strike right here in the center. Let's put our stock way out here, maybe at 90. And it starts moving up. And what it does is as it moves through this bell curve, you can think of that it's starting to fill in that bell curve. And these are where your deltas are coming from. As that stock moves, it's starting to fill up more. When it gets to half of the curve, you've got roughly delta 50. There's 50% chance for it to go in the money, 50% for it to go out.
Roughly, depending on the time.
As it moves through, now here we would have delta 1. And this is saying that the stock is so far out this way
the option
that according to the bell curve, it's not even going to hit this strike anymore. It's just statistically to where the point of no return. Now remember, that does not include changes in vol or news. You can't say
it doesn't mean because you have a 100 delta option, that doesn't mean it won't become a 0 delta option sometime down the road.
According to the bell curve and nothing else, it does mean that mathematically.
But we know that's not reality.
But we know it's true because news can hit. So the thing that you have to see is that let's first take a look at this idea of this red, this bell curve getting filled in. If we looked at just that process, we would
which is why we love synthetic puts, right, Bill?
That's one of the main reasons we
sell that stock against those deep in the money calls, and bang, you have a synthetic put for nothing.
There you go.
And then you watch the stock tank and you made money again. Beautiful thing.
If we say the process of stock moving through the bell curve, we would see this. So it's the same idea. So here was the stock way here, and we see there's not a lot of deltas. Why? Because there's not a lot of area filled in that bell curve. As the stock starts moving up this way, what happens? We start filling in more. When we get to the halfway point, where do we hit? Look at that. Right at
the
50.
Money.
Well, that's just telling us you are halfway through the curve. And then we start coming up where? And we hit 100. That just tells us you are 100% through the curve, and that's delta 1. Now, a little side note for people, a little of the math here. Sometimes people say, what's this 1 standard deviation and 2 standard deviation stuff? Are they just made up points? Nope, they're not. Once we have a bell curve, doesn't matter how short or wide it is or tall and skinny, they all have certain characteristics. These standard deviations are what are called inflection points. And what that's telling you is that if you come up here, and you can see that we're starting to rise, like a rocket taking off, and right there, we hit a point where we're still rising, but we're rising at a decreasing rate. So it's called an inflection point, and those points will always be the same no matter what the shape of the bell curve, assuming it's a normal curve. So they are and that's why we use them, because now if we just have our simple go-to bell curve, it applies to all of them. We just look at
this. And this whole bell curve stuff, everyone, this applies across all industries. It's not just us that uses this.
That's one of the things that makes it very
all over the place. Plus or minus, you hear, plus or minus and five percentage points or once, whatever the standard error mode. Like that's where this is coming from.
Right. So now what I want to do is we're going to go back to the bell curve and we're going to overlay them. Now I've done a little trick here. We've talked about this in a previous one, the significance of 0.4. And that happens to be the number that lines up at the top of a bell curve. That's I'm not going to get into the math, but it's the height of the curve at 0. And that's why we've talked about that if you have a 1-year option at 20% volatility, you can multiply those together, 0.4, you get 8. And the 1-year option will trade for about $8.
$8.
And so for any other option, you just have to scale by the square root of time. But that's where that 0.4 is coming from. So what I've done here, you might be saying, hey, wait a minute, we're not at 0.4, we're at 1. Well, what I've done, because if this is 0.4 and this is 1, this black curve is going to get just crushed. So what I did is I divided all these values by 0.4. So that 0.4 now becomes 1. And that way we can see them better. But the shapes and the relationships are exactly the same. And what
Bill, are you suggesting that there's a little bit of a shortcut in here that we could kind of look at a volatility level and we could start with a 1-year option and we could sort of guesstimate what that option should be trading at?
Oh, absolutely. Yeah.
That's interesting, isn't it, guys? So like Bill was using 20 times that 4 or 0.4, right? So he's getting 8. If we were using 30, it'd be 12.
Be 12.
And that's what you're going to see. And that's kind of what it should be at that level of implied volatility. Higher vols, higher prices, lower vols, lower prices. And
if you take
there's lots of ways to go out into the future to kind of see where these options should be trading at. And that was part of your thing. That is part of what you need to be able to do as an option person, to be able to say, well, if this, and this happens, then this is where my strategy is going to fall. Right. And not that this, and this is going to happen, but that's your risk management tool, right? That's your what if scenario, just like you do in stock. I buy it at 100. Well, what if it goes to 110? Okay, well, you made $10. What if it goes to 90? I lost $10. So you've already put that equation into the thinking. Yeah. Because this is a derivative product, people tend not to do that, right? They just don't connect the dots and don't connect the idea that the option, really, when you delve into it, the option is really trading with the stock, and that you have to take that extra step and say, well, where's the strategy going to be? It's not so simple as, well, the stock went up, the option went up, right? It doesn't really work that way.
Exactly. So the thing that we want to show here, now that we've kind of got them on the same scale, notice that they cross. And I mentioned earlier that this is one of what we usually call kind of the interesting crossing points in options. So what happens once you hit the peak of this bell curve, notice that black line starts dropping off rapidly. And the red line is what? Increasing rapidly. They have to cross. And they're going to cross at a point at roughly the same point every single time. Now, the thing to understand is that gamma and theta are derived by the height of the curve. That's why if you double volatility, the curve gets cut in half, and your gammas and thetas are going to drop in half. And so anyway, if you have the theta would double, your gamma is going to get cut in half. But so your gamma is there, but your delta is here. All right, so delta lives, let's say, on the area under the curve, and the gamma theta live on the height of the curve. So what it tells us is that there has to be a point where they meet. And what is that point telling us, and why is it significant? So that's what we're heading out to find. And before we do, quick reminder, marketrebellion.com/get started for all kinds of materials just like this. So here's where we're leading up to, Stu. What I did here is I put deltas on my horizontal, and I'm looking at the extrinsic value as a fraction. And it's really the only way we can do it, to put it on a delta scale. So what this means...
As a fraction of what, Bill?
The extrinsic value is a fraction of itself.
Of itself, got it.
So in other words, if we have a very low delta, 0.01, 100% of that option's value is coming from extrinsic value.
Got it, okay.
Okay. If we have a delta of 0.16, still and out of the money, we know that 100% of that value is coming from extrinsic value. Once we hit delta 50, what happens? Look at how rapidly this starts to fall. And this is also why it's really concerning when we hear people say, oh my gosh, I'm starting to get my theta starting to kick in. Well, yes, it is. You have to understand it's going to happen quickly, especially as that option starts moving in the money. So notice what happens that right at the halfway point. And what this means is that half of the option's value is extrinsic, and therefore half must be intrinsic. And where's that going to happen? Looks like somewhere right around, it's hard to tell on this scale, but somewhere in the maybe mid-60s.
Yeah, mid-65. That's where those two items
be 65. Exactly. So the thing is that this has to happen. It's not just, well, we've noticed it a few times. This is a direct result of options pricing. It is not, again, just it works a lot of times. It's an absolute mathematical fact. Now, before I put to go further, it's not exactly delta 65. It does depend on interest and dividends and volatility, time, but if I had to give it a range, I'd say probably 61 to 64 most of the time.
I was going to say 3 plus
63, but usually just to give it that nice round number.
Yeah, 3 like off of 65, 62.
Yeah, true. That's the go-to number. That's the thing to understand, right?
Yeah.
So to see that in action, we thought this would be kind of a cool thing. Let's do a little demonstration.
And just to clarify real quick, Bill, you had mentioned that as the option is moving up towards at the money and then going in the money, your theta is going to increase. And absolutely. So let's just make sure everybody understands your extrinsic value is going higher. You know, the options price is going higher.
Towards at the money, sure.
It's not in the money yet. It will be eventually if the stock keeps going, but yeah, the dollars are still 100% extrinsic dollars, and they are going to be going higher. That's you making money actually if you own it. And the stock is continuing to head towards wherever it's going, and the option will become at the money. And then when it starts to go in the money, then you're picking up intrinsic value, everyone, and your extrinsic value is beginning to decrease as well as your theta.
Right. So let's do some, and these are some things that you can do at home. This is from option-price.com. I have the underlying stock at 100, strike at 100, 30 days. I'm going to take interest and dividends out. And I do that not necessarily make it realistic, especially with the interest, but it's done to make the analysis cleaner. You're not getting an effect from interest. It's just strictly from stock and volatility and the things that we're more interested in. We're trying to just filter those out.
Isolating movement with respect to volatility.
Exactly right. We're just a good word. We're trying to isolate it. So now if we click on calculate, we get the options price of 229. And in fact, if you took your little trick of doing 0.4, but scaled that by the square root of time, you'd come up very close to 229. So now let's fish around here for a little bit, Stu, and see if we can find where we find a halfway point. Now, there are some little tricks we can do. I'm not going to go into them here, but I just want, if people want to just do it on their own. So let's just do the hunt and peck method. So I'm $1 in the money. I have $1 worth of intrinsic value. And how much extrinsic value? Well, we subtract off $1. I've got $1.83 of extrinsic. So I have more extrinsic. We're not balanced yet. Now I find it easier to say there's $1 worth of intrinsic, and 2 times that would be $2. And so we still have, you can see now we're not balanced there. So we have to keep playing around. Now I think if we go to 101.60, we get 319. So $1.60 twice is what? 320.
320.
So we're basically a half and half.
So Bill is 160 in the money. That's your intrinsic.
Correct.
And the option is valued at roughly 320 here. So, take the intrinsic out of the full value, and what are you left with? You're left with the extrinsic.
$1.60, right. So we've got a 50-50 split. And where do you suppose that's happening, Stu?
I'm going to guess it's around 65-ish delta. There you go,
that.
62, right? Plus or minus.
Look at that. Right about 62. All right, so now let's try another one. Let's bring this back to 100. Let's go out to, let's try 365. And there's our $8 price. 20 vol times the 0.4, that's the height of the bell curve. There's our $8 price. Again, not exact, but certainly close enough.
Yep.
And now, because we're going out more in time, we're going to have to bump up the price more. So I'm going to say, let's try 102. Not even close, right? $2 of intrinsic twice would be 4, far more extrinsic value.
Yeah, and think about that, everyone. I mean, this is a great exercise for everyone to get in there.
I agree.
Just play around with it. $2 on a year-out option that's trading at $8. What's that?
Not going to be close.
It's not going to do anything.
Correct, and that's why I want people to do this. I agree. It's a very good learning tool. So now I've got $5 of intrinsic, and I've got
and that has so much to do with so many things. Think about your gamma, your delta. How much of your delta is really changing on a $2 move on a year-out option versus now play the game. Do that same thing with a 1-week option and see what happens on a $2 move.
And that's also why we
can delta.
I said there were some shortcuts we could do, and that's where you could kind of find out by looking at your deltas. But just to make the point, let's go 105, and then let's do 105. We have $5 of intrinsic times 2 is 10. We're getting close.
Mm-hmm.
But let's do 105.65, I think.
Looks like Bill's done a little homework here.
565 twice is what?
1130.
About 1130. And we've got what?
1130. And there's your 65 delta. Look at that.
And look at that, right at 65. Magic. Oh my gosh, what's going on here, Stu? Yeah. This is an output of the pricing math.
So that would be that crossover thing that Bill was doing.
That's the crossover point. That's right. And if you don't know, there's a lot of these interesting ones. We talk about option pricing principles and crossover points with graph. You have to understand they're very interesting inflection points, possible decision points for traders. And if you don't know these, you're missing the information that you're trying to trade on.
So how many times do you think out there people say to themselves or say to us as teachers, coaches, well, what strike should I buy? See, wrong question.
Oh yeah.
Right. Identify, do I want intrinsic? Do I want extrinsic? Where's that happy medium? Well, maybe this is it, right? This will tell you where you need to be with, aligning with the goals that you've set for yourself.
Absolutely true.
And then all those kind of questions they go away.
Yep. Let's try one more. Maybe we can trick it with a higher vol. Let's go to 40 vol. We'll go to 60 days. And so now we get a price of 646. 100% is extrinsic value. And
At
so
the
let's
money.
go to 10. Now here again, think about this. We got 646 of intrinsic. We're not changing time. If I go to 102, do you think that's going to do it?
Nah.
Of course not. But again, if you play around with it, you'll start to see. So now I could say I've got $2 of intrinsic times 2 would be 4. Not even close. The option we're trading it for, we'd have our meeting point. So I say, okay, let me go to 104. $4 twice is 8. We're getting closer. And let's try 104.60. And what do we got?
460 times 2 is
920.
920.
And close enough. And where do you think we're going to land here, Stu?
All right, where we thought we would land.
Look at that.
That's how these things work. Yeah.
This is how they work. And if you don't understand, and there are so many of these things, there are so many of these interesting properties and crossover points and fundamentals. And if you don't have a strong base, everything else crumbles. So if you think you're going to survive by saying, well, let me watch MACD, and when this crosses over, I'll buy the option and I'm going to make money, you are fooling yourself.
Yeah,
and in fact, Stu and I in Miami are going to show you some very cool live demonstrations where you can actually post artificial quotes, but up on a screen through your phone. We're going to do live markets, and we're going to show you why, in one case, that everything like this is going to collapse into randomness.
Bill, we gonna play make a market? Is that what it's called?
We're going to do that lots of times. We're going to do it
Nice.
Under no information, under asymmetric information, under news hitting. We're going to show how bubbles form, how crashes form. We're going to look at the limit order books, marginal pairs, Schelling points, Nash equilibriums. We have lots of things that most people have never heard of, and it's going to be.
And people are going to be involved in making the market, right? It's not going to be
right. This isn't a
me up there
45-minute
making a market.
No,
we're going to get people involved. Make me a market.
Yep.
And we're going to show you how these things develop. And are we going to start like without any markets? Like here, make a market, make me a market in this option.
We're going to do that to show how they get formed for anything. So we're going to do a very interesting one. But anyway, it's going to be a lot of fun. So for anybody in the Miami area or anywhere else who'd like to join us, definitely call your sales rep. It's going to be a tremendously, we're super excited about it. We've wanted to do this for a long time. But let's go ahead and summarize this. Delta 65. At roughly delta 65, the intrinsic value equals the extrinsic. And below 65, the option is driven more by what? By the height of the curve, more by gamma and theta. But above 65, it's being driven more by delta. So what does this mean? Well, lots of implications. If you're trading gamma, if you say I'm a gamma trader, a reasonable place to close is at delta 65. Why? You're pretty much getting tapped out of gamma. Not gone, but it's that transition point. Sometimes we call it a handoff point. It's where we start handing off from being more gamma theta driven to more delta driven.
I just thought of something. So people, let's see, I'm going to buy this like stock replacement ish kind of option, higher delta, 80, 85, maybe even 90 delta. But I see that these volatilities are through the roof.
Right.
And I'm worried about the theta that's going to come up with that high volatility, because I've learned that high volatility means high theta. But you don't get it. See, you don't have this.
Just going to say exactly. You would know it doesn't matter.
it doesn't matter. You're getting into the high delta. The extrinsic value is kind of going away. You don't really the level of implied volatility that you're seeing in that high delta option. I'm not going to say it's meaningless, but it has a lot less to do with it than if it were at the money option. A lot less.
Yeah.
Extreme, really super high implied volatilities, which tend to last in the big picture like 10 minutes. Maybe then we might want to take a look at it. But most of the time, it's
not even
it's not even a thing. It's not even a thing.
Now, to add to that, why don't we typically go 80, 85 for stock replacement. Why don't we go to 100? Make it behave exactly like stock.
Because you showed that before. I was thinking about that as you were showing something. There's that, it doesn't, what you're buying for the intrinsic value isn't really giving you anything.
Exactly. It all comes from this.
Yeah.
It's a sweet spot. We'd like to get some leverage. We just want to get way away from the extrinsic value. We want to get very much into the delta. And again, that's what, if you understand these concepts, that's when the lights will go on. You'll say, now I understand. I'm not doing it because somebody told me, which as Stu said, a lot of times it's wrong anyway, but now you'll know and you'll have confidence.
And on that other topic we were just talking about, like you're not even thinking, I haven't even mentioned the skew, the smile.
Whole different conversation.
Curve that's going on with that high volatility. It's coming from with 25 cents worth of extrinsic value, maybe. Which could even be, kind of showing up, in our examples, we don't have any interest rates, but not in other ones, you will, and it might be showing up as part of that. And it's a meaningless number. It doesn't mean anything.
So now if you hit 65 delta, maybe you bought it as a 40 delta, or maybe it was a high delta, it fell and it's now back to 65. And now the stock starts running. A lot of times people say, oh, I'm so afraid of theta and I need to close it. Well, no, theta is pretty much becoming out of the picture now. It's becoming more of a delta play. And if you're
all delta
or feeling like this stock's going to move, forget about the theta. It's exactly where you want it. And so it could pay to hold because theta is really less of a threat. Delta is starting to dominate.
Bill, so we had a query recently. I think you might have seen it in your email from one of our people who had a stock replacement option, and I kind of forget what stock it was. Doesn't matter. Did pretty well on it. Caught the relative bottom-ish there when temper tantrums. Tariff tantrums.
Although it did cause temper tantrums.
Yeah, absolutely. And did really well on it. And now is kind of thinking about, well, what do I want to do with the money? Should I plow it into 5 at the monies or 7 out of the monies, right? It's a completely different ball game, that type of option versus that 85, 90, 95 delta option. See, that's people get carried away with the leverage. Maybe you're abusing the leverage.
Not hard to do.
Not hard to do at all. It's really easy, in fact, to abuse the leverage.
And in fact, we're going to talk about this in Miami as well. Part of the reason is that people think dollars are risk. And they'll say, well, if I paid $1, I've got low risk.
Dollars are known. How can they be risk?
Probability. You've probably got very low probabilities.
This is a probability game. It's a probability of an outcome in the future.
And that's why we have to talk about the math. We don't like doing it, but we have no choice but to at least show you. Now, again, do you have to know the math? No, but you need to have confidence that there is a real reason why this has to happen. And so, like you said, that's a good dividing line. That was a good example with the tariff tantrums. You're saying, okay, do I want to play more delta?
Yeah.
Maybe not stock replacement. Well, maybe a 65 would be a good starting point.
It's a super reasonable compromise.
Super reasonable compromise.
And Bill, you talk about that a lot. If you can't decide, there's reasons. Like, why can't you decide? There's pros and cons.
Because there's equal pros and cons, right?
Well, maybe 65 is the compromise. Maybe you're kind of getting a little of both when you go with the 65.
And if you're thinking, I believe there's going to be this fast aggressive move, we get our bull kicker off of maybe the 500-day moving average. You say, I think there's going to be a fast aggressive move. Well, maybe we want it somewhat below 65 to play that gamma.
To play the gamma, of
Right.
course.
You don't want to
Yeah.
say, "Oh, I want to play gamma. I'm a gamma trader. Let me buy a 70 delta option." No, it's basically gone. And yet people we find that people do this all the time.
Or maybe even the slightly out of the money, 40 or 42 delta option where you can play that gamma up towards
Oh,
the
absolutely.
money,
Absolutely.
right? And then flip it to start going the other way and take advantage of it by getting that little cheaper dollar option on that little tiny bit of the out of the money,
Yeah.
and then taking advantage of the gamma. Yeah,
All of the
absolutely.
above are possibilities. So anyway, those are just some very basic ideas, but you have to understand them. And so get on a pricing model and play with it, and it should become very clear. So for now, I think y'all know the answer. What's significant about Delta 65? Not so generic anymore. If you are a real options trader, you should say, it's probably where intrinsic and extrinsic value are about equal. And that would be a really good answer. Anything to add to that, Stu?
Yeah. So listen, here's the idea. The idea is to know the product. Know what it is that you're looking at. Know what you're looking for. Have an idea. And don't, like Bill said, you don't have to know the math. It helps, obviously, but you don't have to know it intimately. It's just have an idea. Get in the game. I say that a lot to people. Just get in the game. Get in the
I think
game
it
of
helps to know that there's a mathematical principle behind it, as opposed to just saying, "Oh, this is the stock to buy," or "This is the option to buy." Why?
this
Well, I
is
don't know. I
this is
just
the
think
way it is, right?
this is the way it is.
This
No,
is all based. It all comes from the mathematics.
right. People have often
But
said you don't need to know how an internal combustion engine works, or a lot of days now, an electric engine, to know how to drive a car. So
right.
no, you don't need to know the math, but you need to understand that there is a very good and sometimes some heavy math that is driving it. But that's what's going to give you the confidence to know that these numbers are true.
Here's a little sidebar on this 65 delta also.
Let's hear it.
So we generally speaking, right, not all the time. There's never a never, and there's just never an always. But generally speaking, we kind of think about implied volatility heading south on the way up and heading north on the way down, right? They have that inverse relationship. So if you're buying a 50 delta option or a 45 delta option, and you're betting the direction that you're betting is north, from a reasonable approach, you can expect that the vols will drop.
Especially if you bought it in high vol.
Especially if you bought it in high vol. That's absolutely 5,000,000% correct.
Yep.
And if you choose to then move away from that higher Vega number, so by going into that 65 delta option, you are now using the delta to a small extent, a little bit, to hedge what you think I'm not going to say implosion, but the downward drift of the implied volatility. You're using the delta to hedge the vol drift to the downside.
Exactly.
Right. And you could do that on the other side as well with the puts, because on the downside, it's just the same discussions the other way. On the puts, you're kind of thinking as the stock goes down, the vols are going to go up. So you don't really need that 65 delta. You kind of prefer to have the 45 delta, because you could take advantage of the vol tilt going up, not tilt, but the volatility going up as the stock is going down. Yeah. And you use the gamut in that way. So another little thing about this delta.
One of the things I love about that is, because we get these questions a lot and comments from people who say, "How do you guys possibly learn this stuff? I don't understand a single thing that Stu just said. It's so complicated." And what was it? It was two principles. It's knowing about this Delta 65 crossover and knowing that vol typically goes down on the way up and up on the way down.
Typically.
If you know that, suddenly you've got lots and lots of possibilities that open up.
Yeah.
And that's why it's so important to understand these fundamentals. So we hope that helps all of you out there. We hope to see many of you. I know we're going to see a lot of our Q&A people out there. We're looking forward to meeting you. It's going to be a lot of fun in Miami. Contact your salespeople. And with that, Have a good rest of the week, and we will see you next week for Coach's Corner. We'll see you then.